South Africa's largest real estate group, Growthpoint Properties, reported that its distributable income per share rose by 5.2% in the first half, lifting its shares. However, revenue fell by 4.8% in the period as it continued to be impacted by the COVID-19. Its 50% owned V&A Waterfront development improved its contribution to distributable income by 54.8% in the period as lockdown restrictions were lifted and tourism resumed. For more, we are joined by Growthpoint CEO Norbert Sasse. Norbert, thank you so much for your time. Let's review the 6 months that was for Growthpoint.
Sorry, Nastasia, would you mind just repeating that for me?
Let's review the 6 months that was for Growthpoint.
Sure. Sorry about that. Yeah, so look, I mean, certainly a much improved performance for the 6 months compared to the comparable period, a year ago. Improvements across many sectors of the business. Very much improved contribution from the V&A Waterfront. Very strong performance from Growthpoint Properties Australia. I think the capital and regional investment of ours in the UK, if anything, I think has sort of bottomed out and things are looking a lot more stable there. And equally, the global worth investment that we have that's got exposure to Poland and Romania, very stable performance. The dividend's a little bit less, but all things considered, a very stable performance from global worth. South African business at an operational level is still finding things tough. But bottom line contribution from SA is up mainly because of lower interest costs, given the fact that we raised equity in November 2020 and settled a big chunk of debt with that, so big interest cost savings. So, we're very encouraged by the fact that, we're able to show some growth in the dividend per share and in our distributable income per share. It feels like, we've turned the corner and things are looking better. But we still remain, a bit concerned about the South African environment where what we generally refer to as the property fundamentals, vacancy levels, negative reversions on lease renewals and rentals, lack of rental growth, costs growing at a faster pace than income. Those elements still worry us domestically.
From the office side and specifically South Africa, what's the strategy on that front, especially as companies try to navigate this whole hybrid working model?
So, office sector is the one that we're struggling with the most. Our vacancy levels there are a shade over 20% at the moment. A big chunk of that actually sits in the Sandton area. We've seen large corporates all indicating that they're returning to the office and that they're returning to the office with, let's call it, with a vengeance. We see traffic return to Sandton. We've seen traffic return to Cape Town and the southern suburbs. So we're very encouraged by the fact that major corporates are all returning to the office. And I guess each one of these corporates in the next 6 to 12 months will develop a let's call it a flexibility policy. I don't really want to call it work from home specifically. It's more around the flexibility that they would offer their staff to work, from remote areas, as well as getting back into the office maybe 3 or 4, in some instances even 5 days a week. So we remain concerned about the lack of demand, about the fact that corporates are still. Very few corporates are growing and very few corporates are adding staff. So, in fact, retrenchments and consolidation is still very much the name of the game. In the absence of meaningful economic growth in the country, we think very few corporates are going to go out and expand and invest in new premises and taking on a whole bunch of new staff. So, I guess we look at disposing of some office assets where it's possible. We look at converting, some offices perhaps to residential. There are not that many that, you can do that with, but where it is possible, we're certainly doing that. We're actually converting a pretty big office development in the Bedford View area, an office park, which we're converting into residential at the moment. Yeah. So there are various strategies, but we remain quite concerned.
All right, so the 6 months going forward, what are the key priorities for the group?
So we still remain focused on liquidity and our balance sheet. We've done a great job, to my mind, in keeping our loan-to-value ratios at around the 40-odd% level, just a shade under 40 at the moment. We still have great access to liquidity, but we continue to focus on maintaining, our loan-to-value ratios, making sure we maintain a strong balance sheet, we maintain strong liquidity. We've got over 6 billion rands worth of facilities with banks at the moment that we can draw on, should we need. We are seeing pretty good growth prospects in our Growthpoint Investment Partners part of our business, which is the funds management side, where we have our fund that focuses on Africa, which is Lango. We have a healthcare fund, and now we have a student residential fund. We think there's great prospects there to add assets and grow those funds and grow the fees that we can earn from those funds.
Yeah.
So a combination of balance sheet management and growth domestically on the fund management side.
Norbert, thank you so much for making time to chat with us. We'll have to leave it there. That is Growthpoint CEO Norbert Sasse.